Here is the bullshit everybody is telling you about investing. Just buy into stocks long term. When there is a crash, use it to buy even more. Long-term stocks are going up, and so you don't have to look at the price at all. That's a lie. Or let's say it's a partial lie, because the reason why the stock market is going up long term is because of monetary debasement. The US money supply expands by 6.8% every single year. That means that when we see a devaluation in stocks, if we just wait for long enough and if the currency has devalued enough, then measured in that currency, of course, the index has to go up. But deriving from that argument that we should just buy stocks at any price is flawed, because we can make the same argument with any asset class, right? Why don't we just buy regularly into gold, or regularly into silver, or regularly into Bitcoin for that matter? What's so special about stocks? Why does everybody has their 401k in the S&P 500? Hi, my name is Gerhard. I've been in the investing game for the last 8 years. I reached my first million 3 years ago, and I did this mainly through active trading. On average, outperforming buying and holding Bitcoin by 2% per month. In this video, I want to share the truth, the real data, what's behind the heuristics that most people use for investing. What we see here at the bottom, that's past return with its correlation on the y-axis to future return. So there is a saying, right? Past performance doesn't predict future performance, but it actually does. When we look at how did the S&P 500 perform in the past time window and look at how does this correlate to its future performance, there is negative correlation. In other words, if the index crashed, it tends to have higher return subsequently. Now, what's the best time window here? When we look at the past window versus the future window, where do we have the highest correlation? The answer is over here. It's at 4,344 bars, so that's trading days. That equates to a bit over 17 years. So in other words, we look at the last 17 years, how did the S&P 500 do in that period? Then we look at the future 17 years. When we compare those two periods, we tend to have the strongest connection. And that's what we see here in this chart. Now have a look at this. The S&P 500 ran very well in the last 17 years. So our forward-looking return for the next 17 years should be below average. And the likelihood is very high. The R squared on this chart is 0.87. But what it also tells us that still, even with that positive performance, we still can expect positive performance going forward, measured in US dollars. And so that's the argument that everybody gives us, right? Don't look at the S&P 500 at all if you've got long enough of a time horizon, let's say 17 years. Even if the price now is high, it will be higher 17 years from now. This is also what this chart here confirms. But again, that's because of the monetary debasement. We can make this argument with any asset. But let's first look at the numbers. What is actually our forward-looking return based on this correlation analysis? The answer is 3.7% per annum over the course of the next 17 years. Again, this is just a model. I cannot predict the future, but historically, this did give us quite reliable predictions. Now, 3.6% per annum doesn't sound great, but it still sounds better than just keeping our money in cash. But again, we don't make an argument here pro stocks. We are actually just making an argument against fiat currencies. When we look at the S&P 500 relative to the money supply, and this is a chart that starts in 1960, we are now at all-time highs. We are at a similar level to the height of the dot-com bubble. Have a look at this, the historical price to earnings ratio of stocks, the Schiller PE, also very close at least to the all-time high at the dot-com bubble. This is a long-term chart. It starts in 1871. But then again, if the US dollar gets trashed over time, everything that keeps its value will go up, measured in US dollars, as does gold, for example. So why do we have our 401ks in the S&P 500, and why don't we just save in gold? Why don't we just save in Bitcoin? What's so special about stocks? Because you can make the exact same auto return correlation analysis for gold. Here, the best time window is 15 years. Here, our highest R-square is 0.83, and this is where we are right now. If gold was completely flat over the last 15 years, we tend to have very high forward-looking returns. If gold, however, performed quite well already in the last 15 years, we tend to have less returns. And if it returned phenomenally in the last 15 years, we are not there yet. We might even get negative US dollar denominated returns. Now this is interesting because the 17-year window for the S&P 500 versus the 15-year window for gold, it's not really that different. Everybody thinks that gold is the risk off asset, that it tends to be safer. It preserves purchasing power better than stocks. But the data shows something different. The data shows that when you are buying gold at the absolute hype, when it ran massively, you can have, even after 15 years, a loss measured in US dollars. And that's only true for gold. It is not true for the stock market, right? Even those data points over here are still above zero. But again, we can make the same kind of argument for gold. Why don't we dollar cost average into gold? What's our forward-looking return for gold using the autocorrelation? The answer is 3.8% per annum. So there's very little difference, 3.68 for the stock market and 3.81 for gold. Both assets seem to be quite expensive right now, but we can make the same kind of analysis for all kinds of assets that keep their value long term. We could look at the property market, we could look at silver, not just at gold, we could look at Bitcoin, whatever we believe is limited in supply and whatever we believe will still stay relevant over the next 10, 20 years. That's the kind of asset we can buy during a crash. And that's the kind of asset we should buy during a crash. Again, because of that negative correlation. Positive past performance tends to predict less performance in the future. Very bad past performance tends to predict future growth. This is not a video that tries to argue that we shouldn't invest at all. It's a video that debunks the myth that we should just buy into the stock market all the time. What we should actually do is just exit the fiat system and then decide what are we buying when we exit the fiat system. Prices going up long term is not its value going up, it's just the US dollar and all fiat currencies for that matter going down over time. When you buy a house today and you sell it 30 years from now, that house will not be more attractive in 30 years compared to now when it has just freshly been built. It will be actually less attractive, but it will be more expensive. Again, because a house doesn't lose its value by 6.8% per annum, but fiat currency does. And so when is the S&P 500 actually a good investment? When are stocks a good investment? Let's have a look at the autocorrelation of the S&P 500 relative to the US money supply. Very likely we want to buy when the S&P 500 underperformed the money supply, and we want to rather avoid buying when it outperformed the money supply. By the way, it outperformed the money supply since the beginning of 2009. This is when Bitcoin was born, just after the global financial crisis. Here is the autocorrelation analysis. So the S&P 500 divided by US money supply. Again, 17 years is the optimum, that's over here, and that's our situation right now. We had positive performance over the last 17 years. We tend to have less performance going forward. Now, this is relative to the monetary expansion. In other words, this model predicts that the stock market will not be able to keep up with monetary debasement over the next 17 years. In other words, the stock market is probably not a very good investment, at least if you just buy broadly the entire S&P 500. Individual stocks, let's say AI stocks that currently benefit from the boom, they might be able to outperform, but just buying the S&P 500 is probably not enough anymore. We have already run too much. And yes, measured in US dollars, it's still better to keep stocks over just paper cash. But as an investment class, stocks are not necessarily attractive. The S&P 500 has a good chance of underperforming over the next 17 years. So really, we want to exit the fiat currencies with something that's not overvalued. Now, I don't want to make this video too long. I don't want to talk about other precious metals or about Bitcoin or about commodities, about the things that might now be long-term cheap. I think it's better to just focus this video on stocks versus gold. Here is gold relative to the US money supply. Gold has already run quite a bit, and so it's very likely also going to underperform monetary expansion going forward. And so what about the S&P 500 relative to gold? So on a chart, we go with SPX/gold, hit enter, and then we get this chart. We could make two arguments. Either the S&P 500 long-term really outperforms gold, or alternatively, maybe we are in a trading range and long-term we will regress to the equilibrium and we are slightly above that. I don't know what the real answer here is, but I do see a lot of volatility. I do see that there are phases where stocks underperform gold by 94%, and then other phases where stocks outperform gold by 3000%. So the decision about what kind of asset class to invest in is much more important than most people want to realize. Most people say, I'm a stock person and I always dollar cost average into stocks, or other people are the gold bucks that don't believe all of this financial wizardry, that always just buy into gold. Really, what we should do is we should be opportunistic. At least that's what this chart here implies. There are phases where it's better to dollar cost average into gold. There are phases where it's better to get into stocks. Other phases where it makes sense to rather buy into Bitcoin. The most important thing is to buy the thing that's cheap and to exit the fiat system as quickly as we can. We do not want to hold fiat currency long term because, again, it devalues by 6.8% per annum. The question is only, what are we buying? And now let's focus on gold versus the S&P 500. Here is the autocorrelation analysis. So we look at the S&P 500 relative to gold. By the way, all of those backtests, they are made with Bitcoin Strategy Analytics. That's a backtesting platform available to all premium members. So you can have a look at all kinds of different cryptocurrencies, but also traditional finance assets, individual stocks or indices, or precious metals, commodities, etc. You can also add your own asset over here simply by searching. And let's say you wanted to backtest wheat. You can just check the Chicago wheat futures, or you've got a more exotic cryptocurrency. You can add that as well. The link to premium is down below. But let's have a look at the S&P 500 relative to gold. And this is where we are. The best time window is 14 years. That's where the correlation is the highest. In other words, that's where the data points are the closest to this regression line. And the circle indicates where we are right now. In other words, the S&P 500 has slightly outperformed gold over the last 14 years. And so its future outperformance is likely going to be a bit lower. But we still expect outperformance. And so the backtest, because long-term the S&P 500 historically did outperform gold, works with a positive drift. As in, when both assets returned the exact same over the last 14 years, we should expect more performance of the S&P 500 relative to gold. But again, that outperformance is very much reduced in the forward-looking 14 years. What is the expected outperformance? It's over here, 2.3% per annum. And so what are the main takeaways here really? The first important takeaway is that we should not just believe the heuristics that other people deploy. We should not buy into the stock market at any price just because it goes up over time. Because it goes up over time because of the devaluation. Really, we just want to exit the fiat system. We want to buy something that holds its value over time. We want to be invested. That's the important message. But we don't necessarily want to be invested always in stocks, or always in gold, or always in crypto. We want to be invested in the thing that comparatively is cheap at a particular point in time. And we can see, especially when we compare the performance relative to the monetary debasement, times when asset outperforms and other times when it underperforms. And we see autocorrelation, as in when in the past an asset performed very, very well, it's likely going to underperform in the future and vice versa. We want to buy the underdog. We want to dollar cost average into the asset that's not sexy at the time. I hope you found this video useful. If you did, feel free to also share this with your friends. A like, of course, would be very much appreciated as well. It helps the channel grow. And if it's your very first time here, feel free to subscribe as well. If you want to become part of Premium, a link is over here. There is a 7-day money back guarantee, so there's no risk to trying it out. Thanks for watching and see you next time. Cheers.